Tariffs are now official and they are live as of February 1st, 2025. And according to the White House, the reason why tariffs are needed is because number one, they're to fight the illegal drug problem. Number two, to fight the illegal immigration problem. Number three, bring manufacturing back to the United States. And number four, to potentially cancel the income tax and replace it with the tariff tax. Now, there are three main countries that are affected by these tariffs right now, which have caught the most headlines. That is Mexico, Canada, and China. Mexico now has a 25% tariff. Canada now has a 25% tariff. And China now has a 10% tariff. What does that mean? Well, this is an import tax. So if you are Ford or GM, you're a car manufacturer, and you're making your car parts in Mexico, now if you want to bring those car parts back into the United States, it's going to cost you 25% more. And obviously some people are concerned that, will this make the prices of things more expensive? Will this make inflation worse? How are people going to afford this? Well, I want to break all that down in this video, but I want to start by talking about this. Who do you think are the three largest trading partners with the United States in order? Take a guess. Number one is Mexico. Number two is China. Number three is Canada. The same three countries which now have a tariff on them. And there's been a lot of talk about potentially canceling the income tax and replacing it with the tariff tax. I have a whole video dedicated to this coming out in the coming days, so make sure you look out for that. But I want you to understand kind of where we are in terms of numbers. Because in 2023, the United States government collected a net of around $4.5 trillion from the income tax. So if you want to cancel the income tax and replace it with the tariff tax, you'd have to imagine that you're going to collect at least $4.5 trillion from tariffs. Well, if you're going to put a tariff on imported goods, you have to know how much money can you collect. In 2023, the United States imported $3.83 trillion, which means if you want tariffs to completely replace the income tax and you want the same amount of money from your tariff tax as the income tax, you have to put on more than a 100% tariff on what all imports in order to generate the same amount of tariff taxes as income taxes. Or you can also reduce the size of government and spend less money. So we know that the 100% tariff is not happening right now. It's a 25% tariff on Mexico and Canada, and then a 10% tariff on China. So based off of those numbers, you're not going to be able to completely replace the income tax and replace it with the tariff tax. But maybe what the White House is working for is to potentially subsidize the income tax with the tariff tax. That way they can potentially pass some tax cuts. Let's see what actually happens with that. Again, I'll be keeping you posted here, and I'll also be keeping you posted on Market Briefs. Market Briefs, by the way, is my free financial newsletter where my team publishes what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and we have hundreds of thousands of investors that read Market Briefs every day. So if you haven't joined Market Briefs yet, I have that link for you down in the description below. But this is where the question now is, are things going to become a whole lot more expensive if our top three trading partners now have an import tax, a tariff slapped onto them? And ultimately, companies will have to decide what they want to do. Are they going to pass the higher cost down to consumers? Meaning, if I have to pay 25% more, am I going to charge you 25% more? Or am I going to eat up the profit? And this is really where time is going to tell. We've seen what has happened in history. In 2018, last time Trump passed tariffs, he passed tariffs on steel. It was a 25% tariff on steel. The price of steel went up for a few months, and then it actually fell after the tariffs were in place, and steel actually became cheaper after the tariffs than they were before the tariffs. And then the pandemic hit and steel prices skyrocketed. So that's kind of the data that a lot of people are looking at, that, well, it's really uncertain. Steel prices went up and then they fell, and so now a lot of people are concerned, what's going to happen to inflation now? And this is where it's going to be interesting, because this is a much more broad stroke tariff, and there is a chance that the prices of things could go up. And now the White House is also kind of saying, well, even if the price of things go up, it'll be subsidized with lower taxes. But this is where there's going to be a lot of interesting things happening, and we don't know for sure until it actually happens. But what we also know is that countries that now have these tariffs aren't very happy. And some of them are already talking about retaliating. For example, let me read you what the Canadian Prime Minister, Justin Trudeau, said about this on Friday. Quote, "If the president," meaning Donald Trump, does choose to implement any tariffs against Canada, we are ready with a response. A purposeful, forceful, but reasonable, immediate response. We won't relent on tariffs until they are removed, and of course, everything is on the table. So what does that mean? Well, it seems like countries around the world don't like the idea of tariffs because it's bad for them, because if these tariffs are effective, that means companies in the United States will not want to make things in Canada. They might not want to make things in Mexico. They might not want to make things in China. That's bad for those economies because instead of buying things in Canada, Mexico, and China, maybe countries or companies in the United States will buy things from the United States or maybe different countries. And so if money is moving out of those countries, you can imagine that the prime ministers, the presidents, the companies over there aren't going to be very happy because they're going to make less sales. And so some of these countries are saying, well, if you're going to tax us, we're going to tax you. And those tariffs can obviously hurt because, well, that means that businesses here in the United States might be selling less stuff there. But again, what is it really going to look like? We don't know. We're not going to know for a little while. Even if countries start to impose tariffs today, we're not going to know what the actual impacts of this are going to be for at least a few months because things have to really start to move down the pipeline to see what the impact is going to be, how the knee-jerk reaction is going to be. Are prices going to go up very quickly? Are we going to see prices stabilize after that? We don't know. We don't know how people are going to react to it. I mean, we saw what happened during the pandemic, that people would freak out and buy toilet paper. We saw the same thing happen when ports were shut down due to strikes and people would freak out and buy things at the store. We don't know exactly what's going to happen, but this is where, again, it's helpful to understand what's happening. That way you can really look at it from a broad stroke perspective as opposed to getting caught up with all the emotions. Now, the question you might be wondering is, which industries are going to be hurt the most? Which companies could potentially be hurt the most? And this is what we have seen so far. With the tariffs on Mexico and Canada, some of the industries that are most vulnerable include the auto industry and agriculture. Some of the top agriculture products from Mexico include tomato, avocados, berries, and peppers. From Canada, they're one of our largest providers of lumber. They're one of our largest providers of dairy, and they're also a large provider of oil. Now, oil has kind of been talked about as maybe oil will bypass some of the tariffs. We'll see where that actually goes because, again, this is so new. We don't know how it's actually going to play out. We don't know what's going to happen on Monday. So I'm giving you the information based off of what we have today. Things can change in an instant, but this is kind of the information that we have today. But the thing that I want you to pay attention to, especially, is lumber. The reason why lumber is interesting is because what do you need to make houses? Wood. And we already know that the United States is facing a very unique housing challenge right now where there's low supply, there's an interesting amount of demand, mortgage rates are still high. Trump has been talking about getting mortgage rates down to 3%. I have another video about that coming as well, how that could potentially happen, if it's gonna happen. But if lumber costs do go up, you can imagine that that would make the housing market a little bit more difficult, because that's going to make building a house more expensive. Now, again, we don't know what's actually going to happen to lumber prices yet, but we saw what happened after COVID when lumber prices did shoot up. It made renovations a lot more expensive. It made building the house a lot more expensive. It helped housing prices go up. So that's something I would definitely want to pay attention to, because inflation, CPI, is measured as a broad basket of the prices of things. But one of the largest factors that influences inflation is housing prices. And so if lumber prices do happen to move up over the next 30, 60, 90 days, that's going to be very interesting, because that could then trickle down into the housing market. And if that causes housing prices to go up more, that could clearly impact inflation, but more specifically the inflation data. And if the inflation data starts to look worse, it's going to put a lot of pressure on the Federal Reserve Bank to not cut interest rates and potentially even raise interest rates. Now, of course, the Federal Reserve Bank, who is the entity that's in charge of moving interest rates, and the president, Donald Trump, have been butting heads. The Federal Reserve Bank is technically not a federal entity. Even though they're called the Federal Reserve Bank, they're actually not a bank, because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash reserves, and they're not federal because, well, they're not a part of the federal government. So that's where we're starting to see a lot of interesting things play out. And I know that this video is kind of just like, well, a lot of confusion. And the reason why is because we don't really know what's going to happen. There's a good chance that the prices of some things will rise in the short term, because what we have seen in the past is people tend to freak out. They tend to panic because they don't know how things will move. We saw that happen with COVID. We saw that happen with the port shutdowns. And we don't know how long these tariffs will last. We don't know if they're going to get bigger, if they're going to get smaller. We don't know what other countries are going to be impacted. We don't know a lot of things. And that's where a lot of people can get confused, and maybe people will want to go out and buy things very quickly before they become more expensive as a knee-jerk reaction, which, yes, could cause the prices of things to go up. But then the question is, what's going to happen after those 30, 60, 90 days after the knee-jerk reaction? Will the tariffs go away? Will they stay in place? And if they stay in place, how big will they be? And if they do stay in place, well, are we going to see the prices of things settle or potentially fall? And that's where it's very important for you to understand what's happening, but then also understand how this can create investment opportunities for you, instead of being the person that's always panicking, because every financially savvy investor is saying, okay, how does this move markets? Now, that's what you want to be looking for as a financially savvy investor. How does these things move markets? Because if tariffs stay in place and they work, meaning they incentivize companies to bring manufacturing back into the United States, what does that mean? Well, that could mean that companies are working to bring more manufacturing plants into the United States. That could create an investment opportunity there. That could mean that companies are now investing in more transportation of products between manufacturing plants. That could impact railroads. That could impact other freight companies. And so this is the way I want you to think as an investor. Not get caught up in the emotion, because there's a lot of emotion out there. There's enough of that. But rather look for the opportunities, because everything is an opportunity when you have the investor brain on and understanding how money is moving. That way you can buy the opportunity instead of being the person that's panicking and freaking out like everybody else. There's enough of that in the news. I want you to understand what's happening. That way you can find the opportunity. But let's take one step back. In order for you to capitalize on the opportunity, the first thing you have to do is worry less about the White House and worry more about your house. That means get your money in order. Stop spending all of your money. Have money to save, have money to invest. If you have credit card debt, you got to pay that off first. Then you got to have some emergency savings. That way, in case anything happens, you lose your job, your kid gets sick, your car breaks down, you have some money to fall back on, so you don't have to go into credit card debt. Okay? Get your finances in order first. Then, once you got that in order, now you got to put money aside to invest. Follow something like a 75, 15, 10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum you can spend, 15 cents is the minimum you can invest, 10 cents is the minimum that you save. That way now, no matter how much money you earn, you're always putting money aside to save and invest first. Now that you have the money to invest, now you can find the right opportunity for you. Okay? You can put your money into something like the S&P 500 and not even worry about the markets, not even worry about the news. You can ignore all these videos. And you just ABB, always be buying. You buy every week, you buy every 2 weeks, you buy every month, you ignore the noise, and you invest in the American economy for the long term. That's strategy number one. And now you do that for the long term, which is decades. Strategy number two is you want to be a little bit more involved. You want to find more unique opportunities. You want to find where the money's moving because you like to do that. I'm not talking about trading. I'm still talking about being a long-term investor, but being more involved to find potential shifts in the markets. This is where now you can invest in your own investor research. That's where you have to kind of build your own financial education and understand the game. Now, yes, I have a ton of resources that can help you. You can watch the free videos on my channel. You can join Market Briefs as a free financial newsletter. Again, I have the link for you down in the description. And if you want more investor research, we have a product called Briefs Pro, where we have financial education, investor research to help you stay up to date on what's happening in the market shifts. So with that, I will see you on YouTube Monday, and I hope now you have a better understanding of what's going on with tariffs. That way you're not panicking and freaking out the way that a lot of people are right now.